the moment liquidity stopped meaning safety. Liquidity was supposed to be reassurance, a promise that exits would always exist. That movement meant protection. For years, London treated liquidity as a shield. If assets could be sold quickly, risk felt contained. This belief still shapes markets today, because liquidity became synonymous with security. And that assumption quietly rewrote behavior. Early markets feared illiquidity. Assets that could not be sold were dangerous. Flexibility mattered more than yield. As systems matured, liquidity deepened. Markets widened. Trading volumes grew. Exit routes multiplied. At first, this was progress. Capital flowed efficiently. Price discovery improved. Participation expanded. But liquidity changed perception. Risk felt temporary. Exposure felt reversible. If positions could be exited instantly, holding them felt safer. Longer commitments seemed unnecessary. This encouraged scale. Larger positions felt manageable. Short-term funding supported long-term risk. Liquidity became a constant assumption, not a condition. Institutions optimized for turnover. Speed replaced patience. Volume replaced depth. Markets stopped asking how liquidity was created. They only measured how much existed, because as long as prices moved, confidence held. But liquidity is behavioral. It exists because participants agree to trade, not because assets demand it. That distinction was overlooked, and it mattered more than anyone realized. When everyone depends on liquidity for safety, safety depends on everyone else staying calm. This is where the meaning of liquidity changed, not as protection, but as a shared belief. And beliefs, once tested, do not fail gradually. As reliance on liquidity grew, behavior adjusted around it. Markets assumed exits would always exist, and that assumption reshaped risk-taking. Positions became larger. Holding periods shortened. Balance sheets relied on continuous trading. Liquidity was treated as permanent because it had been present for so long, and duration creates confidence. Institutions structured portfolios around quick reversibility. Assets were chosen not for resilience, but for how easily they could be sold. This created uniformity. Everyone favored the same instruments, the same markets, the same exits. Liquidity clustered, depth concentrated where activity already existed. This made markets appear strong. High volumes signal health. Tight spreads suggested stability. But this strength was conditional. Liquidity depended on participation. Participation depended on confidence. Few questioned what would happen if confidence wavered, because liquidity itself discouraged the question. Short-term funding supported long-term exposure. Rollover risk was dismissed as manageable because refinancing had always been available. This embedded fragility quietly. The system required constant motion to remain stable. Liquidity also masked leverage. Easy exits reduced perceived risk, which justified greater exposure. But leverage and liquidity are not independent. They amplify each other. As leverage increased, liquidity mattered more. As liquidity mattered more, leverage grew safer. On paper, the market learned to equate movement with security. If prices moved, safety existed. If trades cleared, risk felt controlled. This logic held only in calm conditions, because calm keeps participants aligned. Liquidity does not disappear randomly. It disappears when alignment breaks. And alignment breaks when incentives change. That was the vulnerability no one priced correctly. Not the absence of buyers, but the simultaneity of sellers. Liquidity had been treated as a resource. In reality, it was a behavior, one that could reverse instantly. The reversal began quietly, as it always does. A pause where bids used to appear. A hesitation that felt temporary. At first, liquidity thinned at the edges. Spreads widened slightly. Volumes dipped briefly. Nothing alarming. But liquidity does not fade evenly. It retreats from risk first, then from complexity, then from anything that requires explanation. As confidence softened, behavior synchronized. Participants moved not on fundamentals, but on observation of each other. Selling begot selling, not from panic, from precaution. This is the critical shift. Liquidity vanishes before fear arrives, because participants act to avoid being last. Markets that once absorbed volume effortlessly now struggled to clear modest trades. Prices moved sharply on small flows. Assets assumed liquid revealed their limits. Depth existed only at specific prices. Once breached, gaps appeared instantly. Leverage magnified the effect. Margin requirements rose as prices fell. Forced sales followed, which removed more liquidity. The system entered feedback. Falling prices reduced liquidity. Reduced liquidity accelerated price movement. What had been safety became pressure. Liquidity, once reassuring, now demanded action. Institutions discovered that exit routes overlapped. Everyone had planned to leave the same way. At the same time, this exposed a hidden truth. Liquidity is plentiful when unused, scarce when needed most. Models failed to capture this behavior. They assumed independent action, but markets act collectively under stress. The moment liquidity was tested, it stopped behaving like protection. It behaved like a constraint, and constraints force choice. Not everyone can exit. Not everyone can wait. Liquidity had not disappeared. It had repriced itself violently, and in that repricing, the meaning of safety changed permanently. When liquidity fully reversed, clarity arrived too late. Markets discovered that movement was never guaranteed. It was conditional. The same mechanisms that created smooth exits now accelerated disorder. Speed amplified stress. Institutions built for turnover faced immobility. Assets priced for liquidity became illiquid instantly. Safety vanished not because value disappeared, but because agreement did. Liquidity had always depended on belief. Belief that someone else would act. Belief that markets would remain open. Once that belief broke, no structure could force participation. The lesson was uncomfortable. Liquidity does not eliminate risk. It compresses it in time. What unfolds slowly in illiquid systems happens all at once in liquid ones. London's markets adapted after this realization. Buffers increased. Assumptions softened. Stress was treated as inevitable. Liquidity is no longer viewed as a guarantee. It is treated as a condition that must be maintained. Markets now ask different questions. Not how quickly can we exit, but who exits with us. Because safety is not found in speed. It is found in resilience when movement stops. Liquidity remains powerful, but it is no longer trusted blindly. It is understood as a fragile agreement, one that holds only while confidence holds. This reframing changed modern finance quietly, not by rejecting liquidity, but by respecting its limits. And that shift matters today more than ever. The